has the clause that you're going to want to include, which is this one here, right? It's conditional upon the buyer sitting down, their bum down, but it's also going to want to have another clause. You're also going to want to put in the clause that says, this offer is conditional upon the landlord agreeing to assign the lease over to the new purchaser. Because probably, it being a commercial lease, it says you cannot assign. This is not a residential tenancy. And you have to be sure, what are you buying but the income stream? You can't make the income stream if you don't have the lease. And while it's great that it says that it's going to expire in 5 years, that is not the same thing as saying that the landlord will grant you the right to operate there. So you're going to want to put that in as a condition as well. Those are the two fundamental conditions that you need as part of these agreements when you're buying a business in a bulk sales, in a leased premise. Some of you may have heard of the Bulk Sales Act. The Bulk Sales Act is no longer valid in Ontario. It has been canceled, thank God, and there's been a whole bunch of provisions, like you can only put deposits down of 10%, and you have to actually get sworn statements. All of it is now null and void as of last year. None of that matters. Has no bearing on your life. Much easier for you. And that's it. I'm going to point out to you now that as of February 1st, I'm going to be a lawyer again. Woohoo! I sold my firm last year, and I had a year contract where I said I wasn't going to practice. So I'm starting again come February 1st, which means more melodious sound in my voice as I kind of do these things, and I'm now looking for real estate deals. So gimme. That's it. Questions? Talk to me.
So how usual, from your experience, how usual do you evaluate the price of the business, when it comes to the revenues, like the 4-time revenue?
Right. So let's talk, it's a good question. Only people who are really in business would ask the only question that matters, right? Which is, great, so how do I determine what I'm going to pay? All right, so let's talk about it. The way most of you know how to do it in real estate is through cap rates, right? In commercial. Cap rates, just to be clear, for those of you who are not familiar, cap rates are a measure of what other people have paid for similar businesses. And generally in Toronto, as an example, let's talk Tuckless as it were. In Toronto, the cap rates, because interest rates have been low for so long, for multi-res apartment complexes are now approaching 3% and have been for some time. What that means is you would take the net operating income of, say, $60,000 and you would divide it by 0.03 and you would get your purchase price. That's how you would do on a cap rate basis. Most people do not do cap rate bases, although you can if you're doing sophisticated businesses. But if you're doing hair salons, or if you're doing things like that, what most people do is they just do multiplied revenue. So what they say is, all right, my revenue is $60,000 a year. I'm going to multiply it by a factor in order to get what's payable. Now, here's the bad news. Professional services, anyone want to guess what professional services are valued at? What times revenue? How many years worth of revenue do you get when you sell a... When I build up my esteemed law firm, not Access, that was different because it had other assets, but if I build up MJM Legal into a sterling prince of a firm, and suddenly I sell it, how much can I expect to sell it for? It's a personal service business. 1 times revenue. 1 times revenue. You know why? Because every single one of you who's going to give me a deal, and every single one of you who's going to give me a deal, is going to do so because I'm Mark Morris, not because I'm Mark MJM Legal. And by the way, you're going to be pissed off as hell when someone else takes it over and doesn't provide you the same quality or service. Or if they're able to provide you with a better quality service, probably pretty reasonable bet, then you're going to go to them anyways. They can just go ahead and establish themselves. In other words, there's no real value to a professional service business beyond the person who's selling it in the first place. 1 times value. If you're lucky. If you're lucky. So, my law firm, if I make $60,000 a year clear, how much should I get when I sell? $60,000. And by the way, with it being a law firm, I'd have to even do an earn-out then. Don't ever go into law. It sucks. So that's professional services. Let's talk about better. Hair salons, variety stores, things that realistically have a chance of maintaining the revenue stream are usually valued at approximately 2 to 2.5 times rev. $100,000 nets you really $200,000 now. Maybe less. Not a lot. Well, if you were smart, you wouldn't be a real estate or a mortgage broker. You would own a macro brand. The only smart one of all of us is Eric and Lang, because what they actually have is something similar to Remax. The only people who have been able to actually make many, many, many times revenue are not the people who are providing the service. Greatest of respect to you. One day you'll die and your entire revenue stream gets destroyed. But Remax doesn't supply services. It's just supplying a brand, and it's taking a very little piece of everything, and therefore it has a beautiful revenue stream. And Cloud Realty has a brand new name that it can go ahead and, on a macro basis, lend out. And that has real relevance. It's just throwing that out there if you want to start a new brokerage. Good name. But the people who really make money in this world in real estate are Remax and Royal LePage, the macro brands, and Mortgage Intelligence. And God knows what, these macro brands are the ones that actually have figured out that they can actually scale professional services. But it's not the people who provide the services. We can make a good living. I'm not suggesting to you...
The thing is, for example, if I want to approach, my principal broker, okay, and ask, for example, do you want to see business? Okay, so how would you estimate, the value of this business?
All I would do is one-time revenue. I would not do your mortgage broker, one-time revenue. Now, don't get me wrong. Mortgage broker, so the way it works, just so we're all aware of how the smartness works of various professions. Anyone who chose to be a lawyer is just a moron and gets their ass kicked for the remainder of their life. That's what it is. You aren't going to sell for any value. You're not going to make any money. That's the world of law. I'm not saying everyone. I'm just saying the vast majority. They end up in debt. They make $60,000 a year, God knows. The people who make money in this world are the real estate agents, and the people who make more money than the real estate agents are the real estate mortgage brokers. That's the panoply of that's what you should have done. You should have all been mortgage brokers. You shouldn't have been real estate agents. And the fact that you're real estate agents means that you can go find a lawyer and laugh at them, right? That's where we all stand in our relative positions in this world, like in terms of revenues. And as a result, because there is quite a bit of money in mortgage brokerage still, I've seen mortgage brokers go for slightly more than one time. And lawyers usually go for slightly less than one-time revenue. So 1.25, 1.5, okay, acceptable in mortgage brokerage. 0.6, law, yes, all the time. Real estate brokerage, it's hard to transition. I haven't really seen many people do it. Anyways, let's get off professional services. Hair salons, variety stores, 2 times. And things that are innovative, tech, and things like that, usually between 6 and 8 times. That's the grand scheme that you should be working with in terms of payments. Now, all of that is assuming that the revenue stream remains. Sometimes people come to you and tell you a story, and they say, hey, yeah, I've just signed a contract with Microsoft, and whereas my revenue is $60,000, I expect it to be $200,000 next year. Sometimes that's real. So I want you to pay me on the basis of expected revenue on a multiplier. Okay, so you're going to get way more than times revenue. But we're assuming you're buying traditional businesses that don't have the hockey stick trajectory growth proven and everything else. And so it's roughly where we are. That is how you'd measure it. And again, you do it after you figure out whether the income stream is real and how long it's going to last for, yada, yada, yada. Yeah.
How do you assess goodwill?
You don't, because no one has goodwill. Coca-Cola has goodwill. Microsoft has goodwill. There is not going to be a business that you're dealing with that truly has goodwill. Now, don't get me wrong. Every single seller will tell you about the goodwill. They will all tell you about goodwill. And to some degree, they're not all that wrong. Like some businesses do truly have some goodwill, but it's never valued at what it is you think it's valued. You piss off a client once, that goodwill is down the toilet, right? So, yeah, if you're buying a deli that's 100 years old and that like is an institution of the various city, okay, maybe there's an argument that there's goodwill and we can talk about it. But if you're talking about a business that's 5 years old or 6 years old or whatever it is, and someone says, I have so much goodwill because I'm thinking about Auntie Joan who comes in and orders her sub, screw that. It's worth nothing. Get out of here. What are your revenues? That's all I care about. Don't ascribe any value to goodwill for that.
Okay,
Well, what's wrong with assets that are over 5 years old? No, it's zero for them. Zero for them. You're acquiring those assets. When you acquire those assets, the adjusted cost base resets to whatever it is you've acquired them for. So if you're paying $60,000 for a variety store, the assets of that variety store are what you're paying $60,000 for, and then you are able to, and by the way, it's not 5 years, because you're talking about the CCA depreciation schedules, and those are different based on the classification of asset that you're purchasing, but they all reset to 100 for you. Right? Because it's about a personal, it's about when you personally paid. It's not about how old they are. Does that make sense? Okay. Yep, you can depreciate them. Nope, they're different for everything. So for instance, computers are 3 years. Inventory is 5 years. Auto is, start fresh. You start on the basis of what you paid. So you depreciate on the basis of what you've paid. And so when you purchase, an accountant will allocate certain things. And by the way, I would tell you, part of this agreement, there's something else that needs to be part of your Schedule B. When you are purchasing a variety store, one of the most important things that you can include is a schedule, not only A, but a Schedule B, listing what it is you're actually purchasing. This shelf, this fridge, this freezer, whatever it may be. Because when you purchase a variety store, what you're going to quickly find out is that half those things are owned by Coca-Cola and Pepsi. You're not even buying that. You're buying a lease. That's it, half the time. So you have to make sure you detail what it is you're actually purchasing in terms of assets. But also part of doing that will allow an accountant to value your $60,000 as against particular assets and depreciate those accordingly as against your income. For those of you who are unfamiliar with what we're talking about, just to back up, what we're saying is that you are able to you know how you're able to depreciate real estate at 4% per year? Are any of you aware of that? So if I make $60,000 in net operating income per year, I am able to say, and my value of my building is $800,000, I am able to take $32,000, that's 4% of $800,000. I can't believe I figured that out on the spot. I'm able to take $32,000 and subtract that from the 60, thereby paying tax on $28,000 as opposed to $60,000. That's what we're talking about. We're talking about the level that you can depreciate per year to reduce the tax payable when it comes time to tax. Right? That's just so that everyone is on page. Anything else, guys?
What would be a multiplier on, say, a restaurant or bar or pool hall?
So first off, restaurants are the worst business ever. 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 I used to be in restaurants. In fact, that was my first business. I had a nice little niche business where I was acting as a realtor to all these people who wanted to get into the food courts of Yorkdale and the Eden Center and everything else. I knew my restaurants cold. I had a restaurant, I'm not going to mention which one it is, because they had used me as a lawyer as well. But they're one of the largest restaurant chains in Toronto. Not a keg style, but independent chains. You will know them if I say them. They had on their balance sheet, for 20 years, they cleared $2 million every year. I'm talking NOI. I'm not talking about revs. I'm talking about they cleared $2 million. And that does not even account for the fact that they owned their own meat distribution company. So they were paying themselves, and there was another line item on the meat. By the way, if you ever do meat, you should always establish a meat distribution company, because then you can buy direct from Cargill and you can reduce your cost 30%. It's all very boring. Doesn't matter. Point is that they were able to show $2 million per year for 20 years, no debt. And they went to the bank and they said, we need to borrow, because they were going to do this massive expansion at the time, $6 million. And you know what the bank told them? Boom! Get out of here, because you're a restaurant. And the banks know something that we all know if you've been in restaurants, which is almost none of them succeed. Those that do succeed are nearing bankruptcy every minute of the day. They're just terrible businesses. Now, having said that, if it's a chain, sorry, I haven't turned this off, but if it's a chain business, it's different. I'm not suggesting to you a Tim Hortons or a Subway is a restaurant in the traditional sense. Those have proven track records. That's perfectly stable. Great. I'm talking about something where you don't have the distribution and where there isn't the systems and where there isn't the workflows. Generally, 1 or 2 times rev max. max, if it's a successful business. If it's a really successful restaurant that has branding opportunities and everything else, well, Bob's your uncle, right? Because you can take that, a lot of people will look at that and say, hey, you're known across all of Chicago, and your brand is known across all of Chicago. This is getting back to the goodwill question. I can build this business into something major, and then all bets are off the table. But assuming it's a standard restaurant, I mean, I would be loath to pay more than one, really. Having said that, you'd have to investigate. I haven't sold restaurants like that in a long time. Yeah.
Just out of curiosity, when a client approaches you says, Mark, I want to buy a business, what are your top 5 franchises that you would advise on? Or would you just say completely stay away from franchises?
No. Franchises are like the only thing. Like, I know people denigrate franchises. They say you're buying a job is what some people say. Screw that. Oh, what's the difference if you're buying a job? As long as the revenues are good. Look, Tim Hortons is having trouble as a franchise right now, but it's a very stable revenue stream. Subway, good franchise. McDonald's, good franchise. I mean, I don't need to really go into some of the restaurants. The ones to stay away from traditionally are really all the ones that are eventually acquired by the MTY group. So things like, well, no, that's not true. Big Smoke Burger was just acquired, and they were my former client, and they did great. But I'm talking about things like Mr. Sub. I'm talking about things like Mr. Greek is actually a great one. I shouldn't say Mr. Greek. Mr. Greek makes revenue hand over fist. The coffee time, stay away from it. Like, you know what? If you go on MLS and search businesses, the ones that are for sale en masse, they're always the same. They're always the same.
There's a lot of gas stations, this business exchange,
Gas stations are a very interesting thing. And the problem with gas stations is that gas stations, for a lot of people used to make a lot of money in gas stations. The real problem with gas stations, from my mind, is that gas, this is really off topic, but I'll give you my little 2 things about it. Keep in mind I'm a radical environmentalist. Thing about gas is that the margins were squeezed out at the distribution point. So people were able to get a reliable income stream because gas fluctuation never took place. Whether good economy or bad economy, people needed to drive, people would buy gas. The problem is that people have paid, especially the people who have just purchased real estate, they're paying real estate prices that are incredibly high, predicated upon an income stream that is falling as more and more vehicles turn to less and less gas-intensive options. And that is going to cause a tipping point. And that tipping point is going to start seeing gas stations either substantially revise themselves, which they haven't proven willing to do, or die. And so there is a real risk component that has to be accredited to the income stream, which has not yet started in the resale market of gas stations. They are still reselling for largely the same turnover rates that they were 5 years ago, this despite the fact that every single vehicle operator is now bringing out electric lines. Something has to give at some point. There is a danger point. There's something going on there. And so I'm not confident telling you what I think about gas stations presently. Yeah, I've done gas stations.
What was I know it's hard to say probably, but what was the revenue stream from the store and versus the gas?
The ones that I was involved in was the macro sale where the Circle K's came in, and so I had a very small piece of what was going on with the Circle K. So I wasn't doing individual gas stations. I was doing a buyover of a specific portion of the revenue streams. It was a very different thing. So I can't speak to that. But I can tell you that almost the entire benefit of being a gas station owner is the non-perishables and perishables. It isn't in gas. Also, you should be aware that when you are purchasing a gas station, invariably you are going to have problems upon sale to anything other than gas because of the ESA and environmental problems. Especially if it's an older gas station, gas will have leaked. ESA Phase 2 will be required for sure. Just so we're aware, ESA Phase 1 is just a history of the property telling you, has there been a dry cleaner, has there been a gas station? In your instance, the answer is going to be yes, there's a gas station. Therefore, they're going to immediately order an ESA Phase 2, which is the borehole digging and they're going to find that there has been soil that has leaked. And once you do that, you have remediation costs, which are going to massively negate any of the value of the land. You're looking at hundreds of thousands of dollars in extra. And so the problem with gas stations is as long as you continue with the gas station, you're fine. But if gas as a commodity ceases to be a consumer-based commodity over the next 5-10 years, which is what anyone can see is happening, well, not only do you lose that, but you also have real estate with uncertain value based on the ESA that needs to be done. This is dangerous. This is really dangerous, and I don't know that many people have really caught on to what the danger is. So you're obviously asking because you have dealings in gas stations. I'd be very worried. I stay away from that now. I see that as a huge danger. That isn't, by the way, to say that there's not money in danger. There's huge money in danger. I don't understand how to make it in that instance. So there it is. Anything else, guys? You all sick of my voice? Yeah. No, apparently not.
I came in a bit late, so I'm not sure whether you might have covered this when you started off.
Yeah.
Is it normal to sign a non-disclosure document when you are buying or selling?
Yeah, it is. It's always normal. Look, I don't know what your guys' experience is, but I've done quite a few businesses at this point in my life. I don't give a care. I'm using care because I'm on video. I don't give a care when someone asks me and say, can we sign an NDA? I'm like, well, we can sign an NDA, we can't sign an NDA. You're not going to put the 5 years worth of work into building out this business anyways. Let's just talk. If you're real, you're real. If you're not, you're not. I've never seen an NDA protect anyone in my life. But as most people believe that what they're doing is pure on rocket science, running a variety store, and that they have some cherished secret that is going to lead to the downfall of a government if it gets out, yeah, sign the damn thing. And who cares what it says? Just sign it and do your deal or don't do your deal and walk away. Anytime someone says that, I always look at them and say, good idea. Because what are you going to say? You're a moron? Like, let's just do business.
And the other one was, is 3% really
3% is the cap rate at apartments. In fact, it's lower. It's lower. You can ask Bart. We're seeing apartment complexes trade for 2.3, 2.4 cap rates. It's unheard of, but it's because interest rates have been at historic lows. And the real question, the real problem, is what the hell else are you going to do with money? Remember, this is leveraged money. CMHC will back these buildings. So you're talking about putting down 10% and then making exponential growth on these properties. You'll pay anything for them because if you're someone with tens of millions of dollars, and I understand that that's not us in this room, but there are people with those, what the hell else are you going to do with money? A GIC? Right? It's the secured asset that you understand, which is passive money. Like, there's very little that compares with it. So yeah, you're in the twos at this point for Toronto apartment complexes. Twos. It's nuts. Now, you know what's changed? Class A retail. Class A retail, when I started, it used to be right up there, right after your apartment complexes. Class A retail, Walmart-centered focus, super centers, it has been displaced by Class A office. Class A office is now the valuable asset. Class A retail, still good, but it used to be the gold standard, not even close anymore. The cap rates of Class A office are now well below, which means more valuable, than Class A retail. Anything else?
So
Yeah.
say you make a purchase of a, say, U-Haul,
Yeah.
and the remaining lease is 2 years. After 2 years, what are your options to sell it at its current value, or if the landlord...
Well, there would be no value if the landlord says no. So usually if you have 2 years left, what you do is you say, this offer is conditional upon entering into a new lease with the landlord for a minimum of 5 years or 10 years. And what you try to do is you try to extend the lease, thereby extending your income stream with the landlord. And you'd usually make that a conditional part of the offer to see if, in fact, because there's more value to a longer income stream, you can extend your value. So that's definitely something you'd want to try. Yeah.
I'm just asking this really quick question.
By the way, these are all really good questions, just as an aside. I'm not saying that like a pat on the head, good boy. I'm saying like you guys are asking really good questions.
When I was first taught about commercial deals, one of the things that the gentleman had told me is that we have to always look at the lease, and if it's a really good lease, it's worth a lot of money. Like meaning a really good lease with five options or a 15-year.
Yeah.
Right?
Well, it is because then your income stream can extend for that time.
Right. So my question is, how do you know what the value of that lease is?
It's not what the value of the lease is. It's how many years you are valuing the income stream. So very simple. if I can make $50,000 for 2 years, I'll probably pay $80,000 for that now. If I can make $50,000 for 3 years, I'll probably pay $110,000 for that now. Like, just, I'm using fictitious numbers. But all you need to do is determine how many years are left in the lease. And then you say, okay, now I can figure out what you do is you do a net present value of a discounted cash flow. That's all you're doing. I can show you how to do it in Excel, but you literally write NPV and then the first figure, and then you discount it by, assuming that you're going to get that amount every single year, you discount it by the cost of inflation. You put it over 15 years, you put it at a discount rate of, say, 5%, boom, there's your number. Easy. If you didn't understand what I said, who cares? There's a mathematical way of doing it, and when it comes time to it, you'll call me up and I'll show you how to do it in Excel.
I am familiar with it. The reason why I'm asking about all of these is within my community, like, I'm from Trinidad, so Realty became really popular,
Yep.
So a lot of shops I helped establish when they were really small, now they have huge restaurants. These guys are living in $5 million homes 10 years later. It's unbelievable.
Yeah.
So I saw this happen over and over again, and then when they wanted to sell, they used to call me. Now I don't do much commercial, but that's why I'm here. So
Fair enough. Well, again, keep in mind, the first question you have to ask is there something to the process, or is it predicated upon their individual efforts? Because some people just really like individual owners. Some people have just a great presence, and if that's lost from the business, you're screwed, right? So you have to really determine what you're buying. When you buy a Tim Hortons, it doesn't matter if the person goes home and abuses dogs at the end of the day. There's a workflow, right? You're going to get the same coffee, and it's not going to change. And it's rigorously enforced. And that's the reason the cash flow is dependable. But Roadie Queen doesn't necessarily have those systems. So you have to really investigate that. That's part of the art of valuing your deal.
If I put in a clause for the agreement being reviewed by a lawyer, for
Yeah.
a small thing like this, like it's a store, not that done, how long would a lawyer need to review this?
Okay, so the first thing to understand is that lawyers are morons. Please don't put that out there, but it's true. Look, the vast majority of people who are in the real estate law field are there because they've been unsuccessful in other areas of law. This is the default. This is where we go when we haven't proven that we can work at McCarthy's. Just throwing this out there. And the people who you're going to go to are going to be your traditional real estate lawyers who can barely handle a residential real estate transaction and probably don't know this. And the problem is, unless you're dealing with someone who understands these concepts, you are going to quickly find that the person is going to look at it and say, either A, I could take it on and do it incompetently and I have no experience, or they're going to say, I don't handle this, find someone else. So the real problem is not the review. The review period can be 48 hours. It's going to take no longer than a new build review. The real problem is finding the lawyer who has the competency to do this, because so many of the real estate lawyers that are out there can't even review new build agreements. Forget about business agreements. You have to, so give yourself the time to find the lawyer that can do it. Once you have the person who can do it, 24, 48 hours is really all that's required. I mean, assuming that the document dumps are available, right? Assuming the lease is available, assuming, basic information is available to the lawyer, it shouldn't take very long for them to review it at all. I mean, this is, after all, a hair salon. On a share deal, 90 days. It takes a long time with shares because it's a lawyer reviewing it with an accountant. You have to figure out what losses are. You have to figure out advantageous ways of structuring. You may be applying for CCPC small business exemptions. By the way, when you sell just so you're aware, you know how when you sell a property, you get a capital gains free? There is another capital gains free that we all get. By the way, when I sold Access Law, I didn't pay tax. I didn't pay tax because I have a lifetime capital gains exemption of $850,000, and I established it in a family trust, so I had 4 different owners in my family that all owned $850,000 worth of lifetime capital gains exemptions that can be used. There's ways of structuring things, and all of that needs to be accounted for in shares, which isn't the case with assets. Anything else? We good? Smiles? Fabulous. Thank you for attending today.